Everyone, welcome to Blue Dragon Actuarial. And the topic that we are going to cover today, as you can see on the screen, is expense of management of insurer regulation 2016. Now in India, the way that there is a limit over the total expense that an insurer, life insurer, can do in the financial year. And here, this is all about learning about those limit and how those limit are kind of determined, and that limit is kind of applicable on segmental basis. Like a limit would be applicable for linked business, another limit will be applicable for non-linked business, and within that there will be various segments. So we have to kind of understand how there is the limit and what is the underlying rationale behind kind of settling of those limit. So any insurer transacting life insurance business in India would be requiring to would be need to abide by those limit as provided by the authority. Expense of management in a particular financial year, which with regards to the operating expenses, the amount that has been kind of paid to the as commissions or remunerations to the insurance agents and insurance intermediaries, as prescribed by the authority from time to time, provided that the authority may allow the insurer to pay more than that is prescribed after receiving representation from the insurer, and that should be under the conditions as deemed appropriate by the authority. Also, any remunerations and other commissions that has been paid for from the reimbursement of any expenses or commissions under the inward reinsurance, that is the internal reinsurance or inward reinsurance, provided the sum of 1, 2, and 3 given above would not exceed the specified percentage of the premium, gross premium written in India, and that is specified under Regulation 4 of this regulation. Now, what is specified in Regulation 4? So for single premium business, for single premium, the expense of the basically what is specified is the expense of management of an insurer would not exceed would not exceed the percentage that has been specified below. So for a single premium business, which is mainly the annuity and the deferred annuity business, it should not be more than 5%. For single premium business of other policies, which can be the policy which is not specified in Regulation 1, that is the annuity and deferred annuity, the individual pure risk policies, group pure risk policies, and group fund based policies. Excluding this, it would be 5% for all other policies. So, for example, for an endowment single premium policies, the expense cannot be more than 5%. Right? For individual pure risk policies and group pure risk policies, it is 10%, and it is 15% for group renewable premium, which is basically of 1 year duration. That is for that it is 15%. And for group fund based policies, it will be based on the asset under management. If it is less than 10,000 crore, then it is 1%. If it is more than 10,000 crore, then it is, because then it can be spread over multiple things, right? Then that would be 0.80%. So moving on, so for a deferred annuity kind of product, which is based on regular premium structure, it would be 10% in the first year and 4% for the renewal premiums, and it is one half of 1%, one half of 1% of the annuity paid by the insurer in a particular financial year, 1/20th of 1% of the average sum assured of the paid up policies, right? And 100 of 1% of the total sum assured. Earlier it was average sum assured, but this time it is total sum assured of the lapsed policies which are within the revival period. And so these are all the limits that you have to kind of keep in mind, and it should not, your expense of management under all this, like, it has to kind of abide by all of this rule, but it's not, we are still not done yet. Now for regular for risk policies, like pure risk policies, for regular premium pure risk policies, there is a table which what basically it says is, apart from those those conditions which is kind of mentioned in 1 to 5 above, and also exclude and 7, excluding these conditions, if these are kind of premium policies, so it should not exceed the percentage which is 100% for the first year and 25% for the second year. That is given in the annexure of this regulations. You can see this here. This is the percentage that is kind of written here. However, there is a catch, or there's an exception, provided that if the insurer is in life insurance business, if the insurer has a the policy has a policy premium payment term of less than 10 years, right, then that percentage would reduce to a number which is 7.5 times the number of whole years in that period. So if it is less than 10 years of policy premium payment term, the policy has a less than 10 years, then it would be reduced to 7.5 times multiplied by the percentage multiplied by the number of whole years. And also there is another exception for policies which are, so for policies which are not so there is also a criteria related to the duration. The life insurance is in business, and that is kind of given by a table, which is if the life insurance is kind of in operation in for the first 10 years of operation, between 5 to 7 years it would be 60% for the for first year premium, then and both are inclusive, right? And then 7 to 8 years it would be for 5 to 7 years, it is 60%. Then 7 to 8 years, it is 7 to 9 years, basically 7 to 9, not 7 to 8 years. 7 to 9 years, it is 70%, and 10 years and above, it would be 80%. And the renewal premium in the same classification would be 15, 16, and 17. 18, 19, and 20. And after 10 year of operation, when some economies of scale has been generated, then obviously it will be much lower, right? So in that case, it would be for between 5 to 7 years, it is 60%. Between 7 to 8 years, it is 7 to 9 years, it is 70%, and then 10 years and above, it is 20. It is 60, 70, and 80%. However, the renewal percentage would be always 15% in this case. Once again, there is an exception provided that if the policy premium payment term of the policy payment type is less than 5 years, then in such case, then once again it will multiply, it will be reduced to a number which is 7.5% of the number of whole years, right? So in this case it depends on the duration, and in the previous case it was kind of dependent on the whether the policy is a pure risk business, and then it would depend on the policy premium payment term. Right. So for group policies which are long term, right? All group policies may not be as like 1 year duration policy. For group policies which are long term, those would be classified as first year premium and renewal premium. And the above provisions which are kind of discussed, those would be applicable for a group policies which is only 1 year premium, and those would be treated as single premiums. There is an extra allowance for the expense management policies, which is if the insurance has a principal office located in India, and it also sell business to branches located outside India, so then it would the allowable limit would not be more than 4% of the total premium that is written outside India, right? Now, what is the underlying rationale for kind of this the proportion or breaking of the expense? So this is the basis of allocation. So every insurers need to have a documented policy about the allocation of direct expenses and apportionment of indirect expenses, right? And we already know what are direct expenses. Direct expenses are those which varies with the number of policies. Indirect expenses are something which are fixed, like the overhead, like the rent. Even if you are not selling the policy, you have to kind of pay the rent, right? So those are indirect expenses. So direct expense can be allocated, and indirect expense can be apportioned. So what goes in there is in the documentation would be the expenses which are to be allocated, and basis of such allocation, expenses which are to be apportioned, and basis of such apportionment, compliance with the board approved policy. Basically, these policies need to be approved by the board of directors, and the appointed actuary and the chief financial officer would be responsible for the allocation and apportionment of the expenses, and the allocation and the compliance with allocation and apportionment of the acquisition expense and the maintenance expense. And now this this policy would be subject to yearly review or annual review by the board, and any changes along with the impact on the segment shall be disclosed in the annual report, right? So that's the kind of the most important part. There is a lot of I've seen at least 2 to 3 times questions coming on the allocation and apportionment of expense of this policy, and this is the policy that is kind of audited by the the authority or the IRDA, and they're very, especially for new business, this is very important, the expense management part. Now moving on, the obviously the insurer has to kind of submit returns to the authority. That return has to be signed by the chief financial officer, the chief executive officer, and the chief compliance officer. Now mind you, for expense, actually the appointed actually, that person obviously has a say in that, but it is done by the finance team. It is not done by the actual team. So the finance team will come up with something like, say, out of 1,000 rupees expressed, 100 would go into participating, 200 would go into non-participating, 300 would go into maybe unit link business, and in that way, and in also this much would be allocated to new business, this much would be allocated to renewal business. So this analysis is done by the finance team. Finance team send it to the actual team to review that, and actual team would kind of give their comments and see if something is looking extraordinarily outside, something is an outlier or something like that. But the ownership of expense would be lying with the finance team. Okay, so moving on. So this report, the report that is kind of has to be submitted by the signed by the chief executive officer, chief financial officer, and chief compliance officer. That has to be also certified by the statutory auditor. The statutory, the reports which is signed by this people would be kind of placed before the audit committee. Audit committee is a separate portion of the board of directors who is kind of looking after if the, I mean, three lines. So they are part of the three line of defense of insurer. So they're looking at everything that has been done by the insurer if they are as per rules and regulation. And after kind of approval by the audit committee, this would be adopted by the board of directors, and it will be published as the annual report. And as per the subsection 1 of section 15 of the Act, within following the process and the timelines that is mentioned therein. Now, obviously, an insurer has to, for a newly registered insurer, the authority can exercise forbearance for a period not exceeding 10 years. After a period of 10 years, the excess would be charged to the shareholder account, provided that the insurer comes up with a plan, a business plan, and a timeline by which compliance with that regulation can be can be established. Then the authority might exempt the insurer. Now, for the purpose of this regulation, the life insurance business should be split into the following parts, which will be linked and non-linked. Now, linked can be split into life, then general annuity and pension, health, and variable. Once again, the non-linked non-linked can be split into participating, non-participating, similar classification. Then the variable business can be further split into life, pension, and general annuity and health, provided that it contributes to more than 10% of the total premium written by the insurer. Now, the compliance, if the insurers need to comply with this, with this and any other segment as might be required by the authority, obviously that goes without saying. The insurers need to comply with the expense limit on segmental basis. No, even if they are compliant on overall basis, the excess of the limit might be charged to the shareholder account. So expense, what happens when there is non-compliance? So that is also one of the important part, which is regulation 17 of this regulation. Now, or the sub regulation 17 of this regulation. Now, this, when the insurer is not compliant with the overall expense limit, then obviously the excess would be charged to the shareholder account. There might be a restriction of payment of performance incentive for the managing director or the chief executive officer or the full-time directors or key management personnel. There will be restriction on opening new places of business. In fact, if they violate the segmental basis, I mean if the limit on segmental basis multiple times, then the authority may prevent the insurer from writing business on those segments. However, they will continue to serve the existing policyholder in these segments. There might be a graded penal action as per section 102 of the Act. There might be dismissal of management personnel and appointment of administrators, and any other action as may be seen fit by the authority. Now, obviously, this was a new regulation. This regulation was not prevalent before, so there was some timeline that was given to the insurer to follow this regulation. So the timeline starts from 2016-17. So, and for 2015-16 and 2016-17, the limit, the actual versus allowable limit can be 120%. From 2017-18, it would be 110%, and from 2018-19 and onwards, it has to fall within the expense limit, that is 100%. So an insurer has to kind of understand that these are the limit that is kind of that it is required to follow, and insurer need to write business keeping that in mind. So you understand how important the business plan for the insurer is. If the insurer say writes too many single premium policies, because writing single premium policies might be slightly better for the insurer. It will reduce the ALM risk, and all the profit will be captured at a point of time, but then the expense has to be kind of kept in check, because we know that it has to be 5% for deferred annuity and immediate annuity, and for other business also it needs to be 5%. So the business plan also needs to take into account this, right? And that's why the expense management, the limits on the expense management is very important a part for the business plan. And it is also a bridge or a common area between the finance team and the actual team, because the finance team are the owner of this the over the numbers and limits, but then the actual team has its own say, and it also determines the new business mix that the company would be likely to have. For a major reason for this, for selling participating product, is also related to the expense, which will cover in the participating chapters when we will cover that. So a major portion of that also lies with the expense. So, okay, thanks for watching. And if you like the content, please like, share, and subscribe. I see that many people are I mean, they're seeing the video, but they are not liking it. So if you like the content, please like, share, and subscribe. And if you have any feedback, obviously you can write it in the comment. And yeah, see you in future videos. Thanks for watching.